Hello, everybody. Edgar Denny here, coming to you live from Toronto. I came up to Toronto on Saturday morning to visit my daughter Laura. Laura works and lives in Toronto, and we did watch the game. I'm not sure who we were rooting for. I think we're actually rooting for the Blue Jays, but it didn't work out too well for them. I stayed up until the ninth inning, and I guess there were a few instances in the game where the Blue Jays could have closed the deal, but that didn't happen. And I guess from my perspective, there isn't a big parade out here in downtown Toronto today, so maybe it's going to be easier to get around. I was thinking a little bit about that. Anyways, no Max today. I didn't bring Max with me. Max is happily at home. And I'm happily here with you folks. I think we're all happy with the stock market. So it continues to do extremely well. It's not a perfect bull market. It's got some issues with the breadth. A lot of the leadership continues to be with the Magnificent Seven, and a lot of the leadership continues to be with anything AI related. Today we have, wouldn't you know it, OpenAI once again. Sam Altman. What a wizard this guy is. His latest wizardry is to do a deal with Amazon, where Amazon is going to be building more data centers to be used by OpenAI. I think Sam's been asked a few times how a company that has $13 billion in revenues is going to pay for $1.4 trillion of commitments to hyperscalers, to cloud providers. And he doesn't really answer that question. So if there's a vulnerability in this whole story, it probably is OpenAI. But then again, Altman apparently is intent on taking OpenAI to the public market. And then we'll see what it's worth. If it's worth a lot more than people think, that may provide them with a lot more money to issue stock if they like, and to pay for these commitments that they're making. But I think everybody's somewhat nervous about the pace at which this AI boom is going. I have some concerns, but on the other hand, Amazon at the end of last week reported some interesting developments, and that is that their revenues from the cloud business, just the cloud business, is up 20%. That was much more than widely anticipated. And they attribute it to more use of AI computing, for storage, for whatever else people are doing with AI. So there is a real demand for cloud computing that is related to the AI phenomenon. I still hold to the view that we are in a digital revolution. The digital revolution started back in 1960s, mid-1960s, with the IBM mainframe, and it has evolved since then. The whole point of the digital revolution, as I've mentioned before, is to process as much data as we possibly can, as quickly as we possibly can, and as cheaply as we possibly can. So we've come a long way from the IBM mainframes to the digital equipment, mini computers. Then we had the PCs, the laptops, the software developments by Microsoft, the operating system, the Microsoft Office with Excel and Word. But if you think about it, Excel and Word really were sort of the first big blockbuster hit apps that were introduced in this digital revolution. And they had a tremendous impact on certain companies that could use the Word app, to reduce their dependence on secretaries typing on electric typewriters. And the same thing goes for companies that had a lot of bookkeepers that could cut back on the number by using Excel. But once that app had been kind of fully saturated the marketplace, there really wasn't much else to get excited about. And so we did have this big productivity boom in the late 1990s. Part of it was selling these apps that did have some productivity impact, but a lot of it was simply selling PC boxes to people who were installing them in networks and using hundreds of IT people to do so, because you had to install the PC and then you had to install the latest version of Office, and that lasted until the cloud came into place. And now we don't even really have to buy the software. We can just rent the software. We don't have to update the software because it gets automatically updated within the cloud structure. And so tremendous amount of progress in the digital revolution. And now comes AI. And I kind of think of AI as sort of a monster application that is much more flexible and has a lot more usability than Excel and Word. AI can be used in a whole host of ways that people are only now discovering and working on. I think just about every business is committing some resources and time to figuring out how AI might be a useful tool to increase productivity, to cut costs, and so on. That obviously is having some impact on the labor market and the demand for labor. But at the same time, it's again a huge tool for the potentially huge tool for many businesses. And there are apparently lots of examples of how it's already being used to do so. Now, I stand with my view that AI is artificial and not intelligent. It doesn't recognize words. It's not really ready to do human logic. I see that one of the key officers of Microsoft over the weekend came out with the same notion that AI is not capable of human thinking and human knowledge. It's still basically autofill on speed and steroids. It's really, really fast because of the NVIDIA chips. But we're already getting some news that NVIDIA chips may not hold a monopoly position in that marketplace for very long. I think Amazon is introducing some of its own chips in some of its data centers, and apparently they're cheaper, and they have properties that are fairly useful compared to the NVIDIA chips. So there is competition entering into that realm of things. I guess I do sort of have this view that on the optimistic side of me in AI, that it is in some ways a to infinity and beyond technology. The idea being that, okay, so if the digital revolution is all about processing as much information as quickly as we can, as cheaply as we can, well, the more we do that, the more data we can process, and the more data we find to process. So doesn't this kind of feed on itself? I think the fear is that one day we'll wake up and somebody in the among the hyperscalers, the cloud providers, will say, you know what, we've noticed a significant slowing in the demand for our capacity of cloud computing. We're cutting back on our capital spending on cloud computing because a lot of our customers were looking into AI. They tried it, got frustrated with it, and that whole wave kind of furthered away. Well, I think it's kind of early on to worry about that. I think right now we're looking at some news that suggests that the hyperscalers are correctly perceiving that if they don't build more data centers, they're going to run out of capacity, and capacity is what creates revenues. And so that's the story in that regards. Well, meanwhile, let's look at some more mundane things, less revolutionary developments going on. How about the Fed for starters? The Fed last week announced a hawkish rate cut, hawkish in the sense that the markets were anticipating two rate cuts in October and December. And they got the October rate cut of 25 basis points, But Powell made it pretty clear that that doesn't at all guarantee that there's going to be a rate cut coming in December. As a matter of fact, he pointed out that the federal funds rate is now 150 basis points below where it was in September of last year when the Fed started cutting rates. So last year, the Fed cut rates by 100 basis points. I'm kind of frustrated, folks. The Fed just won't listen to me. I argued last year that the economy was resilient, that inflation was still above the Fed's target, and that there was no rush to lower interest rates. And they went ahead and lowered the Fed funds rate by 100 basis points because they viewed that it was too restrictive, and they had concerns about the labor market. You might recall there was a lot of chatter about the so-called SOM rule, that if the unemployment rate edged up just a little bit more, then the next thing it was going to do was go straight up. And none of that happened. And so it wasn't clear to me, even after the fact, that it was really necessary for the Fed to cut by 100 basis points. And meanwhile, I did warn that my friends, the bond vigilantes, might not be happy with what the Fed was about to do. They went ahead and did 100 basis points anyways. And what did the bond yield do? It went up the other way. It went up 100 basis points. I didn't expect 100 basis points, but I did think there might be an adverse unintended consequence of the Fed easing back then. Well, here we are again. The Fed cut in September by 25, cut in October by 25, so 50 basis points. And the bond yield is around 4.1%, actually. It was hovering at 4% late last week. Now it's at 4.1%. And that's just about where it was before the Fed started to lower interest rates in September of last year. And this should give the Fed some pause because they've cut the Fed funds rate by 50 basis points, but the bond yield still is at 4%. Mortgage rates are still above 6%. And so they do need to consider the possibility that if they go ahead and cut rates again in December, that might get them a continuing unintended consequence of seeing the bond yield going up. So I continue to believe that the bond yields are around 4 to 5%, and that the Fed funds rate maybe back to 4% we're in our perfectly good levels at which the economy can function properly with the credit markets functioning properly. Speaking of the credit markets, getting more and more questions about credit quality in the credit markets. I've been pointing out that some of the cockroaches that have come out in the credit markets, as Jamie Dimon so aptly called them, some of those are really related to fraud. And then I thought about that some more. Well, you can't just dismiss it as fraud. Fraud is the ultimate bad credit. You clearly weren't investigating your borrower very carefully if it all ended with fraud. So it's conceivable that there's a lot more fraud out there, and that forces banks and other lenders in the private credit markets to increase their due diligence on credit quality, and maybe that has some adverse impact on economic growth. We are getting certainly anecdotal evidence that lower income consumers are facing some stresses here, particularly in the subprime auto market. We've had some subprime auto market issues. On the other hand, the evidence is that the older Americans with more net worth are retiring. The baby boomers are retiring, and they are spending significantly. The question is, are we going to lose the consumer, or because the baby boomers, the higher income, and by the way, these are really not higher income people anymore. They're retiring, so the savings rate is likely to go negative, certainly for that group and maybe for the entire consumer sector. But I'm still betting that the consumer sector on the whole is going to continue to spend. We're watching the weekly retail sales reports, and the weekly retail sales reports look just fine. But we're also watching the anecdotal evidence on where some issues might be occurring. Back to the Fed. So I the Fed didn't listen to me this time either. They went ahead and cut by 25 in September, 25 in October. Maybe they're listening to me now, and they're not going to cut in December. The futures market following Powell's or during Powell's press conference last week went from pricing in 2 rate cuts over the next 6 months to pricing in one rate cut. So the enthusiasm, exuberance of the markets for more rate cuts is somewhat diminished. We'll see where it goes from there. We will have some labor market indicators this week. ADP will report, I believe, on Wednesday. And based on the weekly indications, I'm looking for an increase of 50,000 for September. And that would be an increase from I think it was minus 30,000 or so in August. So that might give the market some comfort that things aren't completely falling apart in the labor market. On the other hand, we've had anecdotal evidence, announcements that layoffs are increasing, particularly in technology-related firms. 1,000 here, 1,000 there, 5,000 here, 5,000 there. That does add up. But we'll see how it adds up in the Challenger report on Thursday, because the Challenger people put out an announced layoffs data on a monthly basis, and we'll see what they have to say. My hunch is there will be an increase in layoff reports on balance, and most of it will be in technology, maybe some of it in government. But overall, it shouldn't be a big shocker with a major increase in layoffs. And my reason for thinking that is we actually can calculate the initial unemployment claims data on a weekly basis. The states are still providing the state data. The BLS is closed, so they're not putting it together, seasonally adjusting it and all that. But Bloomberg's been doing it, and Bloomberg's numbers are still under like 220,000 for that number. Let's look at some charts here. I'm working off my laptop. I think the quality of the picture is pretty good. I hope the sound is good. Let's see whether the sharing is carrying works. Yeah, I think it is. So let's try that again. Okay. I hope you're seeing that all right. Recently I've been showing you not just the morning briefing, but also the quick takes. This is the quick takes I put out on Saturday, and this is the blue line is the S&P 500 equal weight divided by the S&P 500 market weight, and you can see the equal weight is still taking a dive, a rather substantial dive. Which means that the Magnificent Seven and other big tech names are doing well, whereas the equal weight isn't doing as well. So the breadth is still obviously problematic, but then again, even if you took out the Magnificent Seven, you'd still have bull market readings for the overall market. This is really what I want to keep you up on top of, and that is the earnings story. The earnings story has really been great. It's really been a major support for the market. This really hasn't been a PE-led bull market. I'll tell you why. We had that lockdown way back when in 2020, and that caused a big significant short crash in the market. The Fed came in, provided liquidity. We recovered within a few months. And with a few months in 2022, I think it's in the summer, we got the forward PE of 22. Led by the Magnificent Seven at 30. Well, we're kind of there now. The Magnificent Seven are over 30, and the S&P 500 multiple is like closer to 23 than 22. So if you go and look at the earnings story, the earnings story shows 100% increase in this number in forward earnings from 2020 following the lockdowns. To where we are right now, and that just happens to be the increase in the S&P 500. So it has been very much an earnings-led bull market, and you can see that earnings are at a record high. We were thinking that forward earnings, which is a time-weighted average of analyst expectations for 2026 and 2025, we thought that would hit 300. Well, it's already there, and now it's going to converge with 2026. Before you know it, we'll be adding 2027. We're looking for $350 a share for 2027. We were looking for $300 a share for next year, and the analysts are already there, and so forward earnings are going to continue to move higher. Look at the quarterly numbers. We had this hook here in the first quarter. We had the hook in the second quarter. They lowered their numbers. They were concerned earlier this year, tariffs and all that. And then it turned out to be better than they expected. Now look at the current situation. They kind of got used to tariffs, got used to a lot of changing of policies coming out of Washington. And yet here we are with another hook. This time around, we didn't knock that down. So it's impressive that even though the estimates weren't knocked down very, very much in recent months, the hook is there again, and looks like third quarter right now is on track to actually exceed fourth quarter, and then we'll probably get a hook in the fourth quarter. This is the growth rates in the hooks, and this is apples to oranges. So we're looking at S&P 500 companies. Let me just check that I'm not running over here. S&P 500 companies today to the S&P 500 companies that were in the index a year ago. And you can see that their expectation now is that this quarter will be up 10.4%. The third quarter will be up 10.4%. When we started out looking at it, this was up more like 6%. So we're clearly seeing another significant, better than expected earnings situation. This is apples to apples. This is on a pro forma basis. Joe Abbott's a whiz when it comes to putting all these things together. And it's just another slice and dice. But this time you're comparing apples to apples. And you can see that we've got over 13% increase when you look at it that way. The revenues on a pro forma for the third quarter just off the charts, up 7%. And so a lot of that has to be the Magnificent Seven, the hyperscalers and so on. You can look at the rest on your own in the quick takes. Then finally, the Fed we talked about. The morning briefing is all about the Fed. And so the Fed is cutting. We pointed out that previous cuts had to do with tightening of monetary policy leading to financial crises, credit crunches, and recessions. This time around, the tightening of monetary policy really hasn't led to any significant crisis, any significant credit crunch, and no recession. But the Fed playing this game of using 3% is the ideal, neutral, long-term Fed funds rate is saying that they're still restrictive at 3.75%. Just a reminder, this was the second quarter. This was the September's SEP, Summary Economic Projections. And you can see that 3%, where does that number come from? It's just an average of guesses. The 4 of the 19 participants of the FOMC believe that in the long run, the Fed funds rate should be down to 3%. And then you've got 9 of them saying that it should be above that, and 6 of them saying it should be below that. So I think the neutral rate's kind of a joke. I've written about it before. We've talked about it before. And that's good. Let's do some discussions here. Let's see. So far, I've got 2 folks. Put on my reading glasses. It was reported that the Fed injected $29 billion into the banking system this weekend. What is your take on this? I think there's some stresses going on in the reserves market. The Fed's been engaged in quantitative tightening. They're trying to kind of fine tune how big a portfolio of securities they need in order to provide the reserves that the banking system needs. And I think they announced last week that they're stopping QT. And I think it's partly because they're seeing some stresses in the banking system. I don't really think it's going to be a problem. They're going to do what they have to do. It's their job. Okay, it's a Cactus. Hi, Ed. What level of bond yield can topple the stock market temporarily, you think, if the bond yield rise continues a bit here in the near term? I think it's not just the level, it's also the speed at which it goes. We had a quick backup in bond yields in 2023 August, September, October by 100 basis points, and that somewhat freaked out the market. Um, I would say something in that order might do it, but maybe it doesn't need to be that much. It could just be something like 50 basis points, so up from 4 to 4.5%. Kind of disabusing the notion that we're going to have even lower long-term rates, and if that's the case, and we get that kind of reaction in the bond market, the Fed might that might be even another reason why the Fed would signal that they're back into no rush to lower interest rates. Again, I think Powell made a good point. It's funny. I gave Powell some credit in the morning briefing. I mean, he's a nice guy. I think he's tried to do the best job he could, and I sort of had a somewhat warm and fuzzy a view of Powell's attempts to do the best he could, and I got some feedback which was kind of nasty that I don't realize how horrible the Fed has been, and starting in 1914, debasement and everything like that. We can get into that issue another time, but for now, I'd say at least compared to uh, Greenspan and Yale, and I think he's done a pretty good job. Um, let's see, Sal Martone. Can you update us on your views for the stock market? Any change in your price target? No, still using 7,000 by the end of the year for the S&P 500, 7,700 by the end of next year. I think there could be a pullback here, given that there are probably too many bulls. I, I think we're still going to continue this bull market. If there is a pullback, I'll try to get the bottom for you, but I don't know that I'd be panicking out of the market here. Okay, Robert, communities communities in my area are enacting ordinances prohibiting the construction of AI data centers due to power grid concerns. Could this become a trend impeding AI developments? That's interesting. Yeah, it's not surprising, right? And on the other hand, there may be other communities, more rural, that gladly accept these AI data centers. So I think they're trying to locate. I mean, they are going to locate where they're welcome, where there's for now enough electricity, and where they're building enough electricity to make it happen. I don't know what the water situation is. I don't know why they're building in Texas when water is kind of scarce there, instead of up by the Great Lakes where there's lots of water. So I'm not privy or understand all that. But I'm going to reach out to Jensen at NVIDIA, and I'm going to reach out to Sam. I'm on first name basis with him, right? No, I'm not. To Sam over at OpenAI, and see if we can do a circular financing deal where I will build a data center in my backyard. I have a couple of acres, not huge, but we could build a data center over there. But I'm sure there's lots of communities that would be delighted to open up a data center. I noticed that Microsoft announced that they're opening up 3 Mile Island, which is shows you how things are changing rapidly in terms of how this economy is being operated. Anyways, I think that's it on the questions. I think that's it on time. Actually, I'm a little bit ahead of time, but that's okay. Thank you for tuning in. This was part of my Roaring 2020s tour. So, kind of like Taylor Swift's been doing her New Eras tour. So I may be coming to a town near you, and I'll let you know and invite you to a meeting, or invite myself to visit with you. But thank you all for tuning in, and let's do this again sometime soon.